Welcome. This is Chapter 7, Part 2, Stocks and Stock Valuation. After having gone through some basic characteristics of stocks, such as authorized shares, issued shares, outstanding shares, etc., and learning how to read stock price and information from common websites such as Yahoo Finance, we'll now be moving towards valuation of stocks. So we'll identify primary and secondary markets for stocks, like we did previously in corporate finance. We'll compute the value of stocks from dividends. So this is the most core part of stock valuation. So let's look at a simple case of CC's Coffee Shop, which issues shares of bar stocks today. Now this is called a primary market transaction, and typically the word that is associated with this is called initial public offering, or IPO. Now let's assume that Mr. Kimani P wants to purchase a stock today, and he understands that the stock would be paying annual dividends of $5 in cash for 10 years. And he also expects to sell the stock at the end of the 10th year, and he expects the price to be $45 per share. He wants a rate of return on 10% on his investment. So what's the price that he should be looking to pay today based on all these parameters? Now, when he is purchasing the stock, he is purchasing it directly from the owners of CC's Coffee Shop, because it's a primary offering or initial public offering. So it is a primary market transaction. But at the time of sale, he's already holding on to stock of some other company, that is CC's Coffee Shop. And when he makes that sale, it does not necessarily get purchased by CC's Coffee Shop. So it no longer remains a primary market transaction. It becomes a secondary market transaction because it's sold to a third party. So that is the meaning of a secondary market transaction. It is a trade that takes place of equity between counterparty 1 and counterparty 2 once the shares have already been issued. Mr. Kimani P's holding period is the period in which he is actually owning the stock, which is 10 years in this case. And this is a finite horizon pricing because we can quantify the amount of time he is holding on to the stock. So now, without any further ado, let's just go into the pricing of this thing. So we go to Excel, and in Excel we look at t equals 0. So this is time, and this is cash flow. So at t equals 0, we have nothing, equals this plus 1, 2, 3, 4, 5, 6, control D, control D, control D, control D. And then we have cash flows. So we don't know what the price we're paying today, but we know for sure that the dividend is 5. So equals up arrow, control C, control G, shift control down, shift control up, control V. Let's do it again. So go up, control C, left, control down, right, shift control up, control V. And then the selling price expected is 45. So he's going to get the 10th period dividend of 5 and the 45. So that's how we actually look at this. Now the rate of return is 10%. So there are two ways to do it. Let's look at the first way. Equals 5 divided by parenthesis 1 plus, and we fix that. So $C $1 to the power of A3, and then we just copy paste that, black cross double click, percolate through, and shift control 1 makes it 2 decimal places, and add them up. So the price today would be 48.07, which is exactly what's available here. So we can use a cash flow analysis to find out the present value of all the cash flows expected from this stock. The other way is just to use the present value function, PV. The rate is 10%, the number of periods is 10, the payment should we receive the price today? No, we should pay today. So it's we should be receiving the $5 for 10 periods, and then at the end of the 10th period we also receive the 45, not 50, because the $5 is already accounted for. So the price type, the cash flow of the price will be negative, because if we're receiving dividends and final cash flow, then we have to pay the price today. So you'll see that negative come in. And now how you avoid the negative? Just make it minus B3 and minus 45. Just flip the signs around of both those cash flows and the value will be positive. So same answer. Both the answers are exactly the same. Oh, here we go. Exactly the same. 48.07. So we must pay a price of 48.07 to achieve a rate of return of 10% or discount rate of 10% through all these cash flows. Now, we've also studied that if the horizon or the holding period becomes infinite instead of the 10 period, then we can use a perpetuity pricing formula. So in other words, if this just goes on forever, the 555, we can actually show that very easily. And we don't even need to go forever. So let me just give you an illustration here. Copy that, Control G, let's go 100, okay, first, and then paste it. So we have 98, so 9900 periods. Now, this will have no longer the $50. Just assume that we just get the dividend, nothing else, okay? And so all we do is Control C, Control left, Shift Control down, right, Shift Control up, Control V. So all these $5. All right, and then all we got to do is the present. Well, let's not do it this way. Let's do it this way. How about this? We hold the stock for 100 periods, 200 periods, 300 periods, and 400 periods. I mean, we have to do the same thing, discounting, but we just use a PV function. So equals PV. The rate is $C $1. The number of periods now is the left arrow. The payment is -5. And let's not assume that we're selling it. Let's just assume the company goes bankrupt instead. So they won't pay us anything at the end. And so this is the PV function used. So we can see the price is $50. If we hold it for 200 periods, the price is $50. 300 periods, the price is $50. 400 periods, the price is $50. So number of periods is E3. The payment is -5. So it's just C over R. Now what if we make this 10 periods? Look at that. 15 periods? Look at that. 20 periods? Look at that. 30 periods? Look at that. So what happens is, let's keep going. 35 periods. So actually, oh wow, good. 40 periods, 50 periods, 60 periods, and we could actually make a graph of how this works. So let's just do that. So let's make a graph and populate this graph. Okay. And so this is the price. As we keep receiving the dividends for longer and longer durations, what happens? So let's go to 70 periods. Now let's just populate this once again. Let's have some fun. So 1 period, 10 periods is $30. Now equals this plus 10. 20 periods equals 42. So you can see the price went up because we received more dividends. 30 periods, price went up, but not at the same speed, not at the same rate. The price has increased, but the rate of growth has decreased. Okay, 40 periods, it has increased, but again the rate of growth is tapering off. It's called asymptotic development of price, because the dividends further away are not as valuable as the dividends that are available to us right now. And 50 periods, well, it's barely gone up from 48.9 to 49.5 or 6. Try 60 periods, 49.84. 70 periods, 49.94. 80 periods, 49.98. In other words, look at that. It's sort of tapering off at $50. But wait, we've already, this is not exact $50. If you see the value of this, you see it's 49.999999. It doesn't exactly become 50. But when does it become 50? When you have infinite horizons. So for example, in a perpetuity, it's just the dividend or the cash flow divided by the rate of return, 10%, 0.1. You can see that's the 50. So that is a connection between growing cash flows and the present value or price of the stock. So the way we can do this also is, now I'm going to remove the graph, because it's not required. If we can actually change this, so let's change this to 5, and then it's just going to add it up, right? And then so Control D, no, that's too much work. Control G, let's put it to A102. Perfect. Just add that. So for a horizon of 10 periods, the price is 30.72. Now let's try it for more periods. So here I have to do some adjustments to the formula. So I have to make sure that the B remains B as I move down, and the C1 can actually change now. So actually let's keep it C1, no problem, and $A3. So I'm going to copy paste this formula now, and then Control G, let's make it 20 periods, okay? So Control G, D22, and then paste, Control V, and now look at the sum. The sum is only adding, so let's make this 102, D102. Okay, so the price has gone up as we knew, right? Now let's try this. Control C, Control, how many periods were there? 20. Okay, let's try it for 30 periods. Control G, E32. So that now we're going to calculate these cash flows for 30 periods, and Control R. Look at that, the price has gone up as more and more dividends are available. The present value is increasing, but not, look at that, it's increased by 12, almost 12. It's increased by only 5. Now we'll jump to 40. Control C, Control G, F42, 40 periods, Control V, and then sum, 48.9. The growth is not the same anymore. Control C, Control G, G52, so 50 periods now. Paste, and then add up, and you'll see the exact mechanics. Look at this last cash flow. Its present value is so small, it's just 0.04. Let's try doing it for 60 periods. H62, and then, oh sorry, not A62 but H62, and then add it together, and the last cash flow is just 0.01 now. So the growth is not the same. Now let's just try 72. So I72, Control V, and then add, Control R, 49.9. So we seem to be leveling off now. Let's try 2 more iterations here. Control G, J82, Control V, and Control R, 49.98. So last but not the least, K92, Control V, and Control R, 49.99. So you can see it's going to that C over R, 0.5 divided by 0.1, the formula for perpetuity. So you really don't need to receive those infinite cash flows to get the same present value. You just need maybe long enough number of cash flows. All right, moving on. So the example here is price paid by Ms. Sophia G for CC's coffee shop. Now this is $0.5 of dividend per quarter, and it's going to pay this forever. The rate of return is 10%, but it's compounded quarterly. So we need to go back and make some modification. So here, all we're going to do is change this to 0.5. Oh no. So let's just fix this. So equals this, Control C, Control V. So everything is 0.5 now. And the price is like this. But the rate of return is no longer 10% because it's 0.5 per quarter. It has to be 2.5% per quarter. And so the price seems to be leveling off where? Let's see. So this is equal to 0.5 divided by 0.025 or 20. So we still need quite a few more periods, perhaps something like 500 periods to get this accomplished, because the farther out cash flows, because the rate of discount is not that big, the farther out cash flows are still valuable. So that's why the price is not leveling off as much yet. So we'll probably need sufficient number of cash flows to get that final value of $20. But not final value, but the present value of $20 using the perpetuity model. To summarize, the constant dividend model with finite horizon is treated like an annuity except for that last cash flow in case we expect to sell the stock. And we assumed that the company was paying $5 dividend in the first case for 10 years, 10% rate of return, selling price of 45 by Mr. Kimani P. We used the annuity formula using the PV function. Rate was 10%, PMT was -5, future value was -45, and the number of periods was 10. And then we got the selling price, a purchase price, a present value today as 48.07. So we saw that already. To conclude, common stock is a financial asset that signifies ownership in a company or a residual ownership. You're only owner to the extent of the percentage of shares that you own. Stock price can be calculated using PV function, and which entails discounting cash flows. So PV function and discounting cash flows are two ways to find out the stock value, stock price today. Holding period could be finite number of cash flows or infinite cash flows. So if we hold the stock for a few years and then expect to sell it at a given price, that is a finite holding period. If we don't expect to sell the stock ever until the company exists, that's infinite cash flows. And that is chapter 7, part 2. Thank you for listening.